When we do Roth conversions, we typically think that we need to identify the right tax bracket to fill up, and then once we fill it up, we're good to go and we've saved money. And while that can be a great place to start, if that's all you're doing, you're probably paying a lot more money in taxes than you need to be. Because there's one specific trap that people fall into, having to do with what's called IRMAA surcharges that cost them a lot of money in taxes, and I'm going to show you how you can avoid that by approaching Roth conversions the right way. To illustrate this point, we're going to take a look at Bob and Sally's plan. You can see a snapshot of what Bob and Sally have. They have a good chunk of their money in pre-tax accounts, which of course means that Roth conversions might be able to help save them a lot of money in taxes if they do it correctly. So if we skip right to the tax strategies relevant to Bob and Sally, I'm going to illustrate the impact of Roth conversions the way they're typically done, show you the benefit, but then show you the trap that most people fall into. And if they just knew that this trap existed, they could end up saving a lot more money than they already are. So what this is showing right here is this is showing Bob and Sally's projected taxable income over the course of their retirement. Their taxable income starts pretty low, but once they hit age 75, required distributions kick in. And because they have a good chunk of money in their pre-tax accounts, those required distributions are pushing them up into much higher tax brackets. You can see that right here. This orange threshold right here, this orange bracket, that's the 24% tax bracket. And at some point in the future, they're projected to exceed that. So what we want to do is we want to see, does it make sense for Bob and Sally to convert some of their IRA balances into the Roth IRAs today when they can take advantage of filling up the 10% bracket, the 12% bracket, even the 22% bracket, so they don't have to pay tax at the 24% tax bracket and beyond later in retirement. So I've already gone ahead and done some of this analysis work, and what I saw was if they fill up the 22% bracket, that's a great place to start. You can see that what that does is it adds $485,000 of tax-adjusted ending assets to their portfolio. This is what their taxable income looked like prior to the conversion. This is what it looks like after. So effectively what they're doing is they are prepaying some taxes at a lower tax rate today so that in the future they don't have to pay at an even higher rate. Now this looks good, and this is a tempting place to stop. You run this analysis, you see that you save almost $500,000 in tax-adjusted portfolio value, and you think that you're good. You think that you're in a good spot, and you go ahead and execute that. But there's a trap here, and I want to show you exactly what that trap is. To show you where this trap shows up, where this hidden tax shows up, I'm going to the cash flow pages for Bob and Sally to show what will their expenses be every single year in retirement. If I drill down into this, this is where Bob and Sally's healthcare expenses would have been before they do any Roth conversions. As you can see, we drill down into this. You can see here's Bob's Part B and Part D premium, his expected out-of-pocket costs, and you can see those changing every single year throughout retirement. So we look at this, and Sally's would be the exact same as we're projecting the same healthcare plan and same out-of-pocket costs for both of them. But look what happens if I click on Proposed Plan. And I want you to focus on this number right here. Age 67, currently, they're projected to spend, and this is just for Bob, so for Sally it's the same, so double it, $6,904. What does that change to under the new strategy, the proposed plan? With proposed plan being what if they do those Roth conversions up until the 22% bracket? Well, this changed. Why on earth did their healthcare expenses change when all we were doing was converting some of their IRA to their Roth IRA to fill up the 22% tax bracket? Well, what changed is something called IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount. And what it does is it takes a look at your modified adjusted gross income, a 2-year look back, and says if your income exceeded certain thresholds, you pay more for your Medicare Part B and Part D premiums, exactly what we're seeing here for Bob in this plan. So here's the implications. Previously, this number was $6,903. Now it's $9,817. By the way, if you're noticing that these two amounts are lower, that's because there's a 2-year look back for IRMAA. And for Bob and Sally, previously they were under the amount. It wasn't until they started doing Roth conversions that pushed them over the first IRMAA surcharge limit. But here's what we need to look at. This dollar amount, when we take a look at both of their healthcare costs, this dollar amount right here is $5,828 more than it otherwise would have been without them doing a Roth conversion. If you want to see exactly why that is, I'm putting on the screen right here what those thresholds look like. And as you can see from those thresholds, if you are single in 2025, and there's a 2-year look back for this, so if your 2023 modified adjusted gross income was under $106,000, no IRMAA surcharge. If it exceeded that, you can see based on this chart here that based upon whatever threshold that would have put you in, whatever income amount that would have been, you are paying more for Medicare. Now this isn't truly a tax, so to speak, but it should be thought of as that. Of the more income you have, the more you're paying with IRMAA surcharges. So back to Bob and Sally. What on earth does this mean for them? Well, they paid an extra $5,828 this year because of their Roth conversions. So if we go back to this page right here, they were converting up to what they thought was a 22% ordinary income tax bracket at the federal level. And they were correct to an extent. They were converting up to the 22% federal income limit, but that wasn't the only tax that was being assessed. If we click into details here, I'll show you what I mean. What you can see every single year in this details section is what the projected conversion amount that Bob and Sally are paying. So what we need to do is year by year say what is the conversion amount and what does that lead to in terms of higher taxes. Technically, there's a 2-year look back on this, so you should be comparing the extra taxes to the amount that you paid 2 years ago. When we start to look at that, it's not just the 22% tax bracket that we're looking at here. If I just take this year's conversion amount of called $170,000 to use a round number and say that that's going to cost them about $5,800 in extra surcharges and extra Medicare premiums, then that's the equivalent to paying an additional 3.4% in taxes that year. So yes, you have the 22% federal ordinary income tax. You have whatever state tax that you're paying that year. Plus, you need to factor this in. And so that's how you need to take this into account. Now, you might be looking at that and say, okay, well, $5,800 in the grand scheme of things is not that much money. Well, here's how we need to look at it in the grand scheme of things. Let's assume that to get that $5,800, you have to pull money out of your traditional IRA. Let's assume, for simple numbers, you're in about the 25% tax bracket. In order to get $5,800 after taxes, you need closer to $7,770 that you pull out of your IRA. So truly what it's costing you is closer to $7,770, but that's just 1 year. Keep in mind that that $7,770 is no longer going to be growing for you for the next 25 years or so of your retirement. If we assume that that dollar amount, the $7,700 and change, could have grown by say 7.5% interest over the course of your retirement, then what that's really costing you is over $47,000 over the entirety of your retirement. So as you look at this, it's not just a few $1,000s that this is costing you. It's those dollars after tax, which means you need a larger amount pre-tax. That larger amount is now having the opportunity cost of not growing for you, and that can really start to add up as that compounds over time. And not to make this overly dramatic, but here's the other thing that you really need to take into account, is if you're converting, let's say up to the 22% tax bracket, and you accidentally convert $1 over into the 24% tax bracket, not a big deal. That one single dollar is taxed at 24% at the federal level, but everything else, all other dollars, are taxed at a lower amount. Well, with modified adjusted gross income, which is what your IRMAA surcharges are based on, if you're even $1 under the next threshold, you're paying the entirety of the IRMAA surcharge. So it's not difficult to see how that one single dollar could end up costing you thousands and thousands of dollars in taxes if you're not managing this the right way. So this isn't to say that it will never be worth it to fully convert up to the 22% bracket or 24% bracket or any tax bracket for that matter. In many cases it is. But the point that I want to get across here is if you're unaware of some of these hidden tax traps, you might end up converting the wrong amount. In doing so, it's going to cost you tens or hundreds of thousands of dollars over time. So let's go back to Bob and Sally's plan. We can see here that if they convert up to the 22% tax bracket, it leads to a positive outcome. Still definitely a very good thing to do. But what if instead of looking at the ordinary income tax bracket overlays here, what if we looked at Medicare premium tax brackets? That's exactly what we're looking at here. What you can see here is their income by doing these conversions is exceeding certain IRMAA surcharge thresholds. And you can see what does that look like? Is if you're under the bottom threshold, it's an extra $88 per month times 12 times both of these couples. If it's over other thresholds, you can see how that starts to increase, so much so that at the highest point, you could be paying an extra $530 per month per couple, and that starts to get very expensive. So what do we do? Well, what if we looked at this from the standpoint of if instead of converting up to an ordinary income tax threshold, even though that's what I'm going to put back on here on the screen, what if we didn't convert up to the 22% ordinary income tax bracket, which is what this was previously looking at? What if we converted to say, how do we fill up as much as we can before exceeding any IRMAA surcharge thresholds? If we refresh that, this $485 turns into almost $760,000 of tax adjusted ending assets. So in other words, they converted fewer dollars, paid less taxes up front, but had more of a gain over time because of this. Now this can be very misleading, and I want to point something out. This is not simply because they avoided IRMAA surcharges. That's a big part of it. The difference between the previous savings, which I believe was around $450,000, and the current savings, about $760,000, certainly part of that is the cost savings from IRMAA surcharges that are no longer pulled out of their portfolio and they can continue to compound over time. Another part of that was just in this specific case, it did make more sense to convert a little bit less than 22% threshold, completely aside from the impact of IRMAA surcharges. So I do want to be very clear that the $300,000+ swing here isn't just as a result of that, but that is a key component here. Now, by the way, as we're going through this, if this seems really confusing and you want to run your own numbers, you actually can get access to the same exact software via the Retirement Planning Academy. Link is in the show notes below. But what I want to leave you with is this. Whenever you do Roth conversions, you have to be aware of all the various potential tax implications. There's 5 specific ones that I want to leave you with. The first is the impact on ordinary income taxes. That's where most people start. They say, what does this look like if I convert up to certain ordinary income thresholds? Most of you are probably aware of that and maybe already have a strategy dialed in to account for that. The second is what we talked about today. Beyond just knowing the impact on your ordinary income thresholds, what IRMAA surcharge impact will there be? Is converting up to a certain threshold beneficial if you only look at ordinary income, but it ends up being harmful when you factor in the IRMAA surcharges or extra Medicare premiums you're going to pay? Keep that in mind as you're doing a conversion. The third implication that you need to be mindful of is what's called the Social Security tax torpedo. As you convert dollars from your traditional IRA to your Roth IRA, there's a very good chance that your provisional income is increasing. Your provisional income is what determines how much of your Social Security benefit is pulled into your total income when determining how much you owe on taxes. Anywhere from 0 to 85% of your Social Security benefit can be taxable, and the amount that is taxable is based on provisional income. So as you do conversions, it can pull in more and more of your Social Security benefit to be included in what you pay taxes on. And because of that, as you convert, it's not just $1 extra in ordinary income taxes, but it might also pull in $1 extra of Social Security benefits to your taxable income. I made a video on that because I know that gets a little bit more complicated. I'm going to point that out as we wrap up this video in just a minute here. But the fourth threshold before we do so, or the fourth implication, is long-term capital gains tax brackets. Sometimes when you're converting money from your IRA to your Roth IRA, it pushes your income over certain thresholds that now any long-term capital gains you have are no longer taxed at 0%, but they're taxed at 15%. So you might see something that makes a lot of sense when all you're looking at is ordinary income tax thresholds. You can say, look, we can convert today at this threshold to avoid paying taxes later at a higher threshold. But what else is that doing when you factor in the implications of your long-term capital gains brackets, which includes qualified dividends? Doing something on one end of the spectrum could impact the long-term capital gains tax that you're paying. And then finally, the fifth implication that you need to be aware of is what tax bracket might your heirs be paying? Why is that important? Well, really, this is only important if you are doing Roth conversions as part of an overall legacy planning strategy, where you're converting your IRA so you can pass on tax-free assets to your children. If that's the case, don't just look at your tax bracket today and later in retirement. Do those two things, but also take into account your children's projected tax bracket. Impossible to say where things will be in 40, 50, 60 plus years, but having a general idea is going to help to inform your Roth conversion strategy to make sure you're taking everything into account. Now, just a minute ago, I mentioned the Social Security tax torpedo, and very few people actually know what that means. It's quite complicated, but it's very important to know for many retirees because it should be a pretty significant factor in determining whether or not Roth conversions are right for you. I made this video right here where I talk about the 3 big mistakes I see too many retirees making. Social Security tax torpedo is number 2. Check out that video, check out the Social Security tax torpedo to see if that's something that might impact you as well. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.